Good evening, traders. Welcome to our session today. We want to speak about swing trading and how you can use macro trades. As we start, apologies for this late start. We had a fair share of technical challenges. I'm trying to share my screen. Is proving a little bit challenging. So Sam, try sharing from your end, please.
Are you able to see my screen?
I can see it on the Zoom. I can't see it on the live stream. Maybe give it a few minutes, a few seconds. Sorry. So as you're waiting for the screen to come up, today we want to speak about something a little bit different from what we've been looking at. Yeah, it's come up right now. So we want to look at macro trends, swing trading the macro trends. So we will start by defining those key terms there, swing trading and macro trends, or what a trend is. Of course, we've looked at these ones in the charts before. Swing trading, it's where you're holding your trades more than several days, several weeks, and even goes to months. And most of the times, what drives that swing, what drives that trend could be a very strong fundamental events coming up that can act negatively on that instrument or positively on that instrument. So you can have a bearish swing, right? Or even a bullish swing, depending on what's prevailing in the market. So how we're merging it with macro is because we have macroeconomic events or macro reports coming up which drive the sentiment across the markets, and you'll find you have a very strong downward move or a very strong upward move. So when we combine all these terms, then we're coming up with how do you do swing trading, using the macro trends. So we will move to define or explain what causes those macro trends, and we'll be looking at banks or central banks, and then we look at how they are manifested in different financial instruments, because after this definition and after that discussion, we'll move to look at it in a few instruments and how it goes. So Sam?
Yes, Matthew. So as you've put it, we are looking at macro trends today, and it's one of the more advanced or slightly confusing topics because most of the times we will tend to focus on technical analysis, and most traders wouldn't want to be concerned with what is happening at the macro perspective, which in all honesty, if you choose to just dwell on technicals and if it's working for you, then well and good. But macro trends tend to explain what is happening to prices based on country-specific factors or regional specific factors. And it's one of the major driving factors that influence how you see price trends over weeks or months in the chart. So understanding or having some knowledge on what is causing, for example, prices to increase over several months gives you puts you at a better position as a technical analyst. For example, if you're trying to anticipate a change in the trend, that's where macro trends come in. Macro simply implies what is the economic and fundamental what are the economic and fundamental factors affecting your price change? And it can be something as simple as we're coming off, for example, COVID. I think we look at that, and we have a lot of activity, and that's causing a lot of demand, which is causing prices to increase, to something slightly more complicated, like things like disinflation that we'll talk about, and in general, central bank policy, which is the major driver for most assets. We do have a lot of professionals in the industry using macroeconomics to sort of factor in or try and have setups based on what is happening at a fundamental perspective. There's this idea of having a macro fund that is sort of one of these funds where they use macroeconomic analysis to assess where the market is heading to. Now, as a trader or as a technical analyst, you'd want to be comfortable with both. You wouldn't want to be clueless in one, because sometimes technicals might not necessarily work, probably because of some fundamental reason or some news that came out on the market. So it's good to be able to factor in all these aspects while you are doing your analysis. And that's what we're going to discuss today. And the key topic we're going to discuss in specific is central bank policy and how that shapes prices and how that shapes how assets evolve over time. And I think we're going to get right into that. So I think I've put here Fed mandate because we'll be focusing on the dollar, even in the examples. But in a nutshell, most of the times we have prices dwelling primarily on what the central bank is going to do. Now, if you think about it, the central bank generally affects the pricing of a currency, how much they're able to offer for you to hold their currency, which is called an interest rate. And through this interest rate, we see that there tends to be a lot of spillover effects into the economy that are key into understanding long-term price movements. And to speak of the central bank mandate, in this case, it's the Fed mandate. The Fed has, or the central bank of any country has its duty or obligation to the country itself. And this might now spill over to assets. So the two main duties for the central bank is to ensure, number one, there is maximum employment, and this is usually proxied by economic growth. And number two, price stability, and this is usually proxied by inflation. So balancing those two is usually key in making any economy grow in a stable manner. And the central bank usually has tools that assist them in this mandate. So the first thing, we'll discuss this cycle before we get into different examples in the market about what is currently happening and where we are in this cycle. And the first thing that you can see at the top of this cycle is economic growth. So during periods of economic growth, of course, we know that we have a lot of activity in the economy. Companies are growing. We have businesses booming and people are getting hired. So there is usually new job openings, wages tend to increase. And what happens during this phase of economic growth is that people tend to have a higher income. And if you have okay, of course, you're going to explain how all this ties down to what asset you're trading, but let's just get the bigger picture for now, which is when people have more money in their pockets to spend, then they start demanding for goods at a higher rate. And that eventually causes an increase in prices in various commodities and assets. Because, for example, if more people start buying cars, then the cost of fuel will eventually start increasing, or the cost of commodities will start increasing. So economic growth, in most cases, usually leads to inflation. Inflation, which simply means prices tend to increase over time due to demand. Of course, when you get into inflation, there is demand pull inflation and cost push inflation. But just to sum it up all nicely, economic growth tends to cause inflation. So inflation is usually an outcome of economic growth in most cases. And in this case, most first world countries usually use this as an indicator for economic growth. So what happens when we start having higher prices is the central bank has to control for inflation, because inflation, if left unchecked, can be disastrous to an economy. So in this case, we have the central bank doing what you call tightening. Tightening simply means making access to capital or access to cash more difficult. An example of this will be if the central bank decides to increase interest rates. over here, if the central bank decides to increase interest rates, then it will be more expensive for example, businesses to borrow cash to expand, and that will lead to harsher working conditions or harsher growth conditions, and businesses might need to stay at the same level. Another example of tightening is when you have a situation where borrowing is expensive for the retail consumer. That means fewer and fewer people would want to take loans. And because you have a high rate of interest rates, then depositing your cash might be more preferred than making a risky investment. So you can see that such things constitute of tightening, which simply means cash becomes less available in the economy thanks to the central bank. And this ultimately leads to an economic slowdown. Now, the purpose of slowing things down is to create the opposite of inflation, which is disinflation. So disinflation simply means a reduction in the inflation rate or a slowdown in the speed at which prices are increasing. And that is usually the counter or the desired effect by the central bank when talking about trying to control prices. Because again, if prices are left unchecked, then you'll have such cases as hyperinflation and all those things. So it's usually a balance between economic growth, which is an outcome of, which is in itself produces inflation, and trying to control inflation. So once you have enough disinflation and the economy starts to slow down, in this case, then the central bank eases monetary conditions. And this is the opposite of tightening. So easing in this case is lowering interest rates so that more businesses can borrow, more businesses can expand, and that eventually leads to the economy booming again. So as you can see from this, there's usually a balancing act between economic growth and inflation. I think, Matthew, anything to add on this?
Well, you've just put it quite clearly on the functions of the central banks, just to make sure that there is moderately or the best conditions for everyone to exist, businesses, consumers, so that no one suffers. And this one means that it means that there is a level of inflation not quite high, not quite low, because again, you cannot achieve 100% employment, right? Again, you cannot survive in an economy which does not have inflation. Remember, you said it's just trying out to balance, because when there is growth, then you expect inflation, but then you don't want it to go very high. So there's always a standard set inflation level. For example, for the US, it's 2%. So you can't survive without some level of inflation, right? But it doesn't have to be so high. And again, you can't survive without, we can't survive with a very high level of employment. There has to be some level of unemployment. It's a balancing act. But then before we go to looking at the example sum, I think I would want to a little bit add to this story on where we are right now and where the story started, where everything started. Remember in 2020 March, okay, around 2019, we had the reports of COVID. Before that, the economies were moving up pretty much well. There are not much shocks in the market, but around 2020 March, especially when we had the reporting of the first case in the US, that's where now the rubber hit the road, because that's where we had a shock in the markets, then a sell-off of stocks, and people start moving to safe haven assets. But now, just to cut the story short, COVID came in, and people are suffering job losses. We went to lockdowns, and people don't have money. So hard economic time. What came up, the central banks came in to do their job. So they're trying to cushion their people. Now they started doing quantitative easing, or trying to reduce the cost of, it just involves so many things, including reducing the cost of loans so people can get loans, pumping in money, that is inflationary measures, to try and pump in money to the economies to help people, even with food, and help corporations to pay their employees. So they pumped in a lot of money. So what that one did, it resulted to inflation. right? Everyone has got a lot of money. It's flooded in the economy. Yet you cannot have like a sizable amount of production or the best word is production or labor to try and match that one. So inflation kicks in, heats up a little bit. Then we have countries seeing it as transitory or like something which will come up, and after some time it goes away. But that one didn't happen. Inflation kept on moving higher. And then just before the inflation goes away, of course, after the COVID eased, then here comes another problem. Now we have a new war between one of the biggest oil producers in the world and even energy like gas producers in the world. What happens? Energy costs go high. So cost of production goes high, fuel goes high, gas goes high, and then again, life becomes hard, right? Because of cost of production pushes the inflation higher. So this where now we had banks, central banks kicking in to try and regulate this overheating inflation. Actually, if you look at statistics, it's like this is the highest level of inflation that has ever been witnessed, especially for countries. Let's use US as a benchmark for countries like US. Yeah. So when Sam, you're mentioning or you're explaining something about the Fed mandate, the same for central banks. Right now we have central banks all over the big countries, Europe or European Union, talk of Britain, talk of Australia, talk of US, trying to increase the interest rates to try and cool down the overheating inflation, right? And what does that one now affect? How does that one affect the instruments that we are trading? That's what we're trying to cover in a nutshell, right? So all those things, and we look at the charts and see, for example, when the COVID kicked in and there was that hardship, what happened to maybe a specific set of instruments? Where now we kicked in and there's energy crisis, what happened to the energy related instruments? When we're having a surge in interest rates actually to a level very high in history, how is that affecting? And how did it cause trends to change? And how is it now informing the sentiments that traders have in the market and then driving the bearish swing or the upside swing? Sam with me?
Yeah, sorry, trying to unmute myself. So yeah, I think you put it quite clearly. Mm-hmm. So now you're trying to find what's the link between all this and asset prices. Yeah,
exactly.
First things first. Let's talk about where we were during COVID. So we had things slowing down because there were lockdowns and everything, and people weren't traveling. Businesses had to shut down and all that. So you had some sort of cooling effect in the economy. Yeah, and what the central bank had to do was to loosen up monetary conditions so that access to capital is easily available and access to credit is easily available, so that people spend more, invest more, because you're looking for economic growth.
Yeah.
But now there's one debate of whether it was too much, whether the easing was too much, or did they overstep in terms of the easing mandate? And that's why you've had historically high inflation rates. So now imagine a scenario where assets are constantly increasing in value, stocks are rising in value, and access to credit is very cheap. Like you can access credit very easily. Like interest rates were below 1% at that time. So imagine the number of people who had the idea to borrow to invest in the stock market was a tremendous amount of people who are doing that. Because if you can borrow money and invest in the stock market and you make your return there, then you can pay back your loan and do the whole thing all over again, because of eased financial conditions where credit was very easily accessible and all that. And this is what led to, in most cases, a rise in stock market valuations, and a lot of stocks started increasing in value. Then again, if stocks are increasing in value, what happens to the dollar when it was readily accessible to everyone? What happens to the value of the dollar at that point?
Goes down a little bit
Exactly.
because of the
So
inflation, right? High supply
yeah,
of the currency.
yeah. So when a currency is in high supply or when a currency is easily accessible, then you find that it tends to go down in value.
Mhm. Yeah. So I think we can use Nasdaq now that you mentioned a little bit about stocks. We can look at the tech stocks and how the trends have evolved for the tech stocks pre-COVID and post-COVID, and then the interventions that came up with the banks, how it has affected all that. If you're able to share the screen some, we can get along. If not, then
Can you see my screen? Can you see my screen?
maybe it's loading. Let's wait for it to reflect on the live stream. I can see it on the Zoom, not yet on the live stream. Yeah, the live stream, yes. So you can get ahead. That is Dow Jones.
This is S&P 500.
Oh yeah, S&P 500. Maybe you can check on
So I
US
can
Tech.
zoom out a bit.
Okay, US Tech. Okay, nice one. Maybe I can start off now that you're sharing the screen. So zoom a little bit. Yeah, that one is better. That one is better. Yeah.
So we
So
had COVID over
yeah,
here.
yeah. That's when the COVID kicked in. Actually, we had the first cases in the US, and okay, US Tech. This is an index which tracks the performance of the US technology companies. Yeah, all the technology companies that you know, Microsoft, Nvidia, talk of Google, all those. Then we can tell a story by looking at this chart here. So at the onset of COVID, then you see there is panic and people are dropping off the stocks, yeah, trying to move to safe haven. That's why you see that sharp downward move there. And then after some time, during that time when the stocks are, when we have that letting go of the stock and the positions, trying to move to the safe haven, that is the same time we had offices being locked and now people are working from home. That's where it's originated. Now, again, it sets in the rush for technology, right? Everyone wants to work from home. You need a PC, you need some very good internet setup. Again, there's that rush for technology. Everyone now is almost watching Netflix. You can remember how the Netflix subscriptions went higher, right? And that's what drove all that upward move, so long as people were working from home. Then at around 2021, that's September, October, if you can label there. Yeah, right at the end of that one. That's when now we had the a little bit of containment of the COVID cases, and people now trying to get to the offices. And at the turn of the year, that is 2021, it's a different outlook than now. It's being managed and all that, right? And then again in 2022, that's when within this period where there's a strong uptrend, that cycle, it's like from November to around November 2020 all the way to September 2021. That's how many months? Around 3-4 months.
From here or from?
Yeah, from down there where the trend
from here.
starts. March, yeah,
From
all the way
to the end of 2021.
I mean, it's more than 5 months or 6 months.
That's more from March 2020.
Mm-hmm.
This is March 2020 all the way to December 2021. That's more than a year and a half. More than a year and a half.
More than a year and a half. So all that time,
Yeah.
that is what was happening. And here there was actually a lot of problems with the COVID. That's what started the whole problems. And governments are coming in to help their people, pumping in money. That's when you can see that's what created that cycle. So what is the macro? What's the macro thing in all this uptrend? There is that challenge of economic growth. Yeah, there is even employment is going down. I mean, like some form of slowdown in economic growth, a lot of money being pumped. Then comes in that part. I think Sam, you can put a different color scheme there where you're marking so you can be a little bit visible. Now, at the peak of all this, that is on December and September 2021, there's a lot of funds, a lot of money, a lot of supply of money in the economies now. Governments realize there's a lot of inflation. All along they were thinking that it's they used to call it is it transitory, that it will end without a lot of interventions. But now it turns out to be quite high. Then we have this phase where you now have a lot of raising of interest rates. Now, with these technology stocks, remember with the tech stocks, they are more based on innovation and a lot of funding to keep on innovation. So when you start increasing interest rates, again, it's a big effect on them because it means now their growth starts diminishing because it means they are paying more. The cost of debt is higher. Now they're paying more, right? So you can see that downward move that is happening there. Currently, at the where you're starting to see like change of character, the price is just like trying to move to the upside as from December, and right in the current situation is where we are seeing a slowing down, especially with the US championing that, a little bit of a slowing down in terms of increasing the interest rates. Remember, previously we even had a 0.5% increase. Now we are going down to 0.25, and that's what is simply changing. So if you can look at this trend, on the 1st March of 2020, we had that very strong dip, and then we had another strong leg up for that rally up because of all the things I've explained. And then we have 2021, the end of 2021, and then beginning of 2022, another narrative driving the price down. So the idea here is, if you as a trader understands the macroeconomic events that are driving the prices, that are driving the economic activities, growth, employment, just everything that Sam explained, talking about growth, interest rates, inflation, if you can understand what's driving all that, then relate it with the instruments you're trading, then you can very easily find the picture and ride the trend. So a very good example here, we have an upward swing, which went for more than 6 months, more than 8 months, I think, all the way to a year. Then there's another swing here, which is pushing to like almost a whole year now, from January 2022 all the way to at the end of the year. Now we're in 2023. Yeah, Sam, you have something to add there?
Yeah. So one more thing about the market is it tends to be forward-looking. And what I mean by that is people tend to front run what they think is going to happen next. And I gave a good example in the other time we were discussing, is if we hear they're going to be, if I'm a real estate investor or a land investor, and I hear they're going to be roads passing somewhere, then I'm going to start selling that piece of land at a higher price, even though the roads have not yet been constructed. That's the same thing with here. If I know the Fed is still going to, or the central bank is still going to keep on increasing interest rates, then I know that this gets tightening. I know that the trend is going to continue and I'm going to be bearish. So in most cases, it's what is the Fed going to do next, other than what is it currently doing now. The market is usually driven by expectations and not necessarily what is happening currently. So let us try and get a glimpse of why we have this sideways trend here at the moment. And that's because we do have a lot of uncertainty with regards to where we think the policy or the Fed policy is going to head next. Sometime last year, they stopped what we call forward guidance. Now, forward guidance is the central bank telling you in a few months, you're still going to increase interest rates, or in a few months, you're going to reduce interest rates. They stopped doing that, and the terminology changed to, we're going to see what inflation is going to come out so that we decide whether you're going to increase. So they stopped giving what we call forward guidance, and now it's a bit for the average investor, you have to look into the data to understand what's happening, which brings us back to our previous slide of the two things that the Fed or the central bank is mandated to do is, number one, employment, which is proxied by the level of employment, of course, and economic growth, and inflation. Those two things will generally guide the central bank on whether to tighten or to ease, and that gives you your forward-looking perspective. So if you know they're going to tighten, then you probably want to be positioning yourself as a seller in this market, because you know that tightened conditions cause asset prices to move down, and easing conditions, or where you see that interest rates are being reduced and buying in more mortgages and stuff like that, then that tends to cause an increase in prices, because cash is readily available, so people can make the investment, and demand for more such type of investments.
Great. That's awesome. Maybe we can move on to like gold, and also explain the trends.
Yeah. So this is for assets. This is for stocks. Yeah. Assumption is, if we have eased conditions, then if cash is readily available, then you're able to make more investments. Even for companies, they're able to grow more because they have access to capital. Yeah. And also valuations are usually based on interest rates. So let's try and have a look at it. And one more thing also, you can notice that most indices have the same sort of picture. They look the same, because now you can tell this was COVID for Dow Jones, this was COVID, and then this was your easing period, and this was your tightening period, and now we are generally uncertain on where the market is going to head next. So this is gold. Gold had more, it was a bit more, you needed the finer print to understand gold, but in general, it is behaving in line with fundamentals. And what do we mean by that? At the moment, we do expect, wait, let me get the date for this, just a minute.
Yeah, maybe as you're trying to get that, can I jump in a little bit and try to explain the same story along with the COVID and where we are. So right at the beginning, you're seeing the chart. Right at the beginning, you can have the panic move where you had the gold sell off, but then after that, the what we call it, the move to safe haven. Try and preserve the amount of money that people had, put it in some precious metal, which is gold, kicked in. That's why we have that buying, that strong buying right at 22nd March. That's where that strong move up started, because people are trying to move to safe haven. That is the time when you had the gold reaching all the way to 2073. That one, which you highlighted. Thanks, Sam, for that, right? And then right after that move, of course, the start of or the easing of the effects of COVID again. So people starting to let off. Just like you were saying, Sam, people will place trades or speculate based on what they are expecting, not probably what has actually happened, but what they are expecting. So at that point, people are expecting that now COVID is getting away and all that. Now they start releasing and moving a little bit to the stocks. Yeah. But then again, seems that it was in for a very long, it was a very long journey before all that one goes away. Yeah. And that is that phase that we have there. A little bit of confusion. It's like cases are reducing, they are kicking in again, lockdowns getting in back, and then we have that other rush on 23rd of January 2023. Yeah, and then the season of rise in rates and all that kicks in, but at around 23rd January, is that where we had the war in Ukraine starting? Some, not quite certain. Around 2022, beginning of 2022.
I think it was towards February, March from here. That's when we started having talk of the likes of the war and everything.
Yeah, because then what happens again with the war, it causes panic again, and people start going to safe haven. Then before we had that sell off, which is because of the rising of interest rates. Yeah. Because when you raise interest rates, again with gold, when you raise interest rates, now it makes dollar very strong. And with a strong dollar and a gold which is denominated in terms of USD, then it becomes expensive. And now you have that sell-off. Yeah.
I think you've put it quite nicely. Because in this first part, we had easing conditions, meaning the dollar was readily available. And that means we had to use more dollars to buy the same amount of gold. And that's why the price of gold went up. So in this case, gold and stocks had the same correlation in that it was being treated like a risk asset. People were investing were buying more gold and all that because it was perceived to be sort of a risk asset in terms of, because the dollar is weakening and there's more cash in the economy, we are going to invest in everything else. And then what happened after the COVID, after 1 year after COVID, we had a lot of uncertainty with regards to in specific monetary policy, and also that relationship between gold and dollar started breaking off a bit. And that's where we saw this massive sideways consolidation for an entire year. Then afterwards, what happened was we had a correction back to where pre-COVID levels were. In this case, the correction was due to the dollar gaining back most of its strength, and gold no longer being treated as that safe investment, because people started thinking we are coming out of lockdowns, the world is not ending, why are we holding gold? So prices started coming down slowly from there. Then currently we have an interesting case because, again, people expect the dollar to weaken. Now, in this case, you have to deduce what is causing price movement in the charts. Currently, people expect the dollar to weaken, and that means, again, if the dollar is expected to weaken, then you're going to need more dollars to buy the same amount of gold, and that's why we have this uptrend. So now, at the end of the day, the story about expectations keeps on recurring. It's probably going to continue recurring until your entire trading career.
Sure. I don't know whether we have any questions. So we've shown the trends that come up. We had a very strong rally, a pullback, then a consolidation, a little bit break of a consolidation. That's how we would consider it in analysis, right? Then we have another strong rally, a strong downward move before having some form of a pullback, and traders will go in to look for order blocks, go to look for trends and all that, engulfing candles, maybe triple tops, like in gold, you can say you have triple tops and all that. But it's also important to understand the narrative behind all that. What are the economic conditions?
Because the narrative is going to assist you. The narrative is going to assist you to know whether that trend is going to continue or it's going to reverse.
So all these traders are going to pick them from fundamental analysis, and mostly for us, in our case, we help our traders to try and understand that in our events, weekly events, which are hosted by Rufus. Rufus Kamau, our market analyst. If you want to understand more on what is prevailing in the markets, what is happening with, for example, USD, what are we expecting, and even with the stocks, it's always it's advisable, and we invite you to join our weekly events with our market analysts. Rufus, we have them. Let me check the schedules. We have them. I don't know whether you have it off from your end. Let me just look at it right now, so you can advise the traders where to come for that advice. So you can join the market snapshot 11 a.m., right? 11 a.m. every single day to understand the macro events that are influencing or are likely to influence what you're seeing on the instruments. It's really very good. Remember, you're not going to piece in all this information at one go. You need to keep on hearing about it. You practice a little bit, and that is a fundamental analysis. Learn how to look at your economic calendar, get the view of the market analysts and experienced traders who have been there. In our case, what Rufus Kamau, our market analysts, will say, and even other analysts that you can find out there. Another thing, if you come in our offices, we'll still speak about these things. We can help you understand how to look at them as well.
Yeah, Matthew, just to add on to that, I think you can view at one more chart, which is USD JPY.
Yes, please, you can have us a view.
So USD JPY was had a very interesting year, and that was this spike up. This is the weekly chart. Yeah, and we had this parabolic increase in prices, which was basically the government of Japan easing financial conditions for the better part of last year. I think this year, for the better part of last year and this year. And what we saw was a lot of traders were attempting to go short on this market because they thought prices have increased enough. It's time for them to go back down. But if you're following on fundamentals, you know that they were adamant on this policy, despite the fact that other central banks started tightening their policies. So this is one way to know when the trend is going to end, because in this case, we had a reversal when they started hinting that they'll abandon their yield curve control policy. So this is a very good example of knowing how to follow the fundamentals.
Awesome. Another great example there. So at least we've looked at the stocks, we've looked at a commodity. We've not had a chance to look at the oil, but the oil, it will be obvious. Prices rising when there is a cut in supply. Then when the war starts easing, then there's a fall in price. Currently, still the war is proceeding, and then we have a little bit of the price getting stuck at a higher level. So the traders can check on that as well.
Yeah.
Right.
I think that's it for today's session.
Yeah.
We'll get more in-depth into it in terms of fundamental analysis and expectations.
Yeah. Right. Hey, hello, Ashil. On the chat, we have Ashil saying hi to us. Hello. Tabitha had asked about the macro trends on gold, and we've already looked at it. Since you don't have any more questions, I think we can call it a session. Thank you so much for taking time to attend this, and keep following up on all this. Keep following up also on the market snapshot with our market analyst, especially at 11 a.m. And you get more enlightened on how to use the macro events coming up in your trading. So thank you so much, and see you next time. Bye.